Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to say Happy Father's Day to all the fathers out there. Really appreciate all of you. I'm sure your kids do as well. I'm putting this video out a little bit later than I typically do. Yesterday, my daughters and my wife decided to start Father's Day a little early. We all went to a movie and hung out together, and then we're going to hang out today as well. So happy Father's Day to everyone out there. In this video, we are going to cover the weekly portfolio update. I did put $1,546 in the portfolio, so let's just jump in. Now, before we get too far in the video, if you could do me a huge favor on this Father's Day, hit that thumbs up button down below. If you find any value in the content, make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Hit the notification bell so you're notified whenever we put out any new content, and drop a comment down below. Let me know if you're a dad out there, and let me know what you are buying this week, any options that you were in, any dividends you received. Would love to hear from you. What's going on in your portfolio? Any questions you'd like to ask, again, drop them down in the comment section below. And let's start off here with options. We did have a pretty good week in options. We did go out a little bit further in a couple of them, but we'll walk through it. On June 10th, we did all of the options. First one was Johnson & Johnson. One covered call here. Again, one is 100 shares. A contract is always 100 shares. So we did one covered call of Johnson & Johnson, ticker J&J, out of the healthcare sector. Strike price of $149, and the close date was June 14th. So for that options, we received $34.45, and it did expire on Friday out of the money. So that means we kept the 100 shares of Johnson & Johnson. We keep the options premium, and then we'll probably run that same play again next week. Now, these other two, I went out to next Friday. So these options didn't close on the 14th, but they were all opened on the 10th. Both of them are covered calls again. One contract on KHC, that's Kraft Heinz Company, with a strike price of $34, expiration date of June 21st, so that'll be next Friday. And for that one, we received $27.45. So this one, just like the CVS one, will expire next week. It's not out 3 weeks, it's out 2 weeks. So I am playing with options a little bit. I think I prefer the weekly options, to be honest with you. You might get a little bit more premium going out 2 weeks, but then you're kind of watching more plays out further than I'd like to. So I think I'm going to stick to weekly options. I've been playing with this for a couple weeks now. I think I just prefer the weekly options. Let me know if you run options for more than a week. I know some people go out 30 days or 45 days or 60 days. I think I like the weekly options, to be honest with you. And then finally, we did one more options play here, one contract for ticker CMCSA. This is Comcast, out of the communications sector. Same June 21st end date, $39.50 strike price, and we received $35.45 for that one. All total, we received $97.35 in options premium, and that goes right back into the portfolio. So this running options is a way that I create a little bit more cash to put back into the portfolio. And like I said, I think I prefer the weekly options. So I'm going to stick to weekly options going forward. These two, along with the CVS one, will expire next week. And I think going forward, I'm just going to do weekly options. Now, we received dividends on June 11th from LyondellBasell Industries, ticker LYB, out of the material sector. We received $157.13, and we do have the drip set. So that means anytime a company pays out dividends, those funds go right back into the company and buy more shares of that same company. In this case, LyondellBasell paid out $157.13. That went right back in and picked up 1.65152 more shares of LyondellBasell, and those 1.65152 shares added an additional $8.84 in passive income over the next calendar year. So that is that. When you hear people say dividend snowball, that is the dividend snowball in effect, right? We've already put capital in to buy shares of LyondellBasell. Those shares of LyondellBasell pay out dividends. Those dividends buy more shares, and those shares add more capital. That is what people mean whenever they say the dividend snowball, right? Now, we received more dividends on the 14th, and we received dividends from Realty Income, ticker O, the monthly paying REIT out of the real estate sector here. We received $65.35 or 34 cents. These funds go right back in, picked up 1.22481 shares of Realty Income. Pfizer paid us $120.28, ticker PFE, out of the healthcare sector. And the $120.28 went right back in and picked up 4.31646 more shares of Pfizer. And Haverty Furniture Companies paid us out $33.22. That's ticker HVT, out of the consumer discretionary sector. And the $33.22 went right back in and picked up 1.23984 more shares. All total, these new shares of Realty Income, Pfizer, and Haverty Furnitures added an additional $12.69 in passive income, with a total of $217.84 in dividends paid out. And then we get into the first new capital added for the week. Was actually done on June 10th. Same day we went in and did our options, we started adding to the portfolio. We added $1,181.80. And with those funds, we picked up 4 more shares of Comcast Corp, ticker CMCSA, out of the communications sector. We picked up those 4 shares at $38.79, and this is the same position that we ran the options on. We picked up 2 more shares of Johnson & Johnson, ticker JNJ, and we picked up those shares at $146.53. Same thing, we ran some options on J&J. CVS, ticker CVS, CVS Health Corporation here, CVS, out of the healthcare sector. We picked up 4 more shares there at $61.04. And last but certainly not least, on June 10th, we picked up 6 more shares of Starbucks, ticker SBUX. This is out of the consumer discretionary sector. We picked up those 6 shares at $81.58. We are continuing to add to our Starbucks position. We're going to continue to build this out until we get to 100 shares. I'm hoping this stays under the $85 mark. I think 88 and some change is where I have my high water mark, what I'm willing to pay for it. I did drop back, I think, into 79, maybe 78 throughout the week. So I could have got it a little cheaper, but that's the way it happens. Whenever you buy the shares, you know, it could drop the next day, just the way the market is. Now, these new shares, this $1,181.80 and the new shares picked up here added an additional $39.20 in capital over the next calendar year. And we added a little bit more on June 14th, Friday here. We went back in and added an additional $365.15. And with those funds, we picked up 2 more shares of Valet, ticker VALE, out of the material sector. We've been nibbling on this one pretty much every week as we add a little bit to it, 2 to 4 shares, I think is what we've been doing. We picked up those 2 shares at $11.25. And our 2 weekly ETFs. These are we're going to buy every week. As a matter of fact, I might double up on SCHD if it stays down below my cost basis. This week it was down a little bit. We picked up that 1 share of the Schwab Strategic ETF, the Dividend Growth ETF, ticker SCHD. 1 share at $76.55. And again, this is a little bit below my cost basis right now, so I may start doubling up on this going forward while it's under my cost basis, just to add a little bit more and bring my cost basis down. And 1 more share of VTI, the Vanguard Total Stock Market, and that's exactly what it is. It's all the companies in the United States stock market. So we picked up 1 more share at $266.09. And we're going to pick these 2 up no matter what the price is. VTI is getting a little up there in price. I must admit, it is hard for me to pull the trigger on this one. I feel like I'm buying at the top. But I'm going to continue to buy. That's the nature of dollar cost averaging. You buy no matter what, and you continue to buy no matter what, and build out these positions over time. And sometimes you'll overpay, sometimes you'll underpay. The idea is that over time you will hit the medium, the average there, and that's what we're looking to do. And these new shares added an additional $8.25 in passive income. We did add a total of $1,546.95 to the portfolio. And with the dividends paid out plus the new capital, it added an additional $68.98 in passive income over the next calendar year. Now let's quickly run through the sector weights here. Communications makes up 9.85% of the portfolio. Consumer discretionary sitting at 6.41. Consumer staples makes up 9.44. Energy sitting at 5.83. Financials at 6.08. Healthcare is the largest slice at 14.42% of the portfolio. Industrials makes up 6.52. Technology at 7.11. Materials sitting at 10.02% of the portfolio. Utilities makes up 9.97. REITs and real estate sitting at 11.07. I believe that is also the second largest position, REITs and real estate. And ETFs still makes up the smallest slice here at 3.27%. Now over here on the right, you can see it's the same sectors, the same percentage broken down, but then you also have the dollar amount associated with each sector as well. And here it is, what a lot of you like to see weekly, and I'm going to show it weekly, whether I'm up, whether I'm down, whether I'm floating sideways, whether the market's up, whether the market's down, whether the market's floating sideways. I'm going to show you a real portfolio built out over time. As I build this portfolio out, I want you to be able to see the ups and downs of the market. You know, some positions are going to be in the red, some positions are going to be in the green. That is the nature of the market. And I want you to see this so that some of you out there who have not started a portfolio yet can build a little confidence, can understand that it's okay. You can be the greatest investors in the world, and you'll have positions that pull back. I think Warren Buffett famously said it. If you can't handle a 50% drop in stocks, you shouldn't be buying individual stocks. And that's okay. If you want to stick to ETFs like VTI or SCHD and don't want to mess with individual stocks, that's perfectly fine too. I'm going to do a little bit of both, the two ETFs plus the individual stocks. So again, some of you out there who maybe haven't started your portfolio, or even some of you who are just newly starting a portfolio, can see the ups and downs so that whenever the downs do happen, when the drops in the market do happen, you don't run away. I always compare it to a store. If you were going to a store and you had planned to buy something and you walked in the store and all of a sudden the store had a sale, would you run out of the store and not buy the item that you walked into the store to buy? Or would you buy it more and maybe even more of it because it's cheaper now? You would probably be excited there is a sale. It seems like the stock market is the only market, and that's what it is. It is a market of stocks, right? That's what the stock market is. That the stock market is the only market whenever there's a sale. Everyone wants to freak out. Why is it on sale? I need to sell before I lose my money. Well, the market tends to. Now, it doesn't always happen. Sometimes companies do go bankrupt and their price just continues to drop. But if the company still meets the criteria you set up, if it's still a good company, if it's still making revenue, if it's still making sales, it's still growing, then when you see a downturn, when you see that red in the stock price, you should be buying more, right? BABA, if I was comfortable paying $75.44, I should be more than comfortable paying $73.35. Comcast, if I was buying it at $41.67, I should really like it at $37.44. Nothing has changed with these companies except the stock price has dropped, right? So I look at the red in my portfolio as buying opportunities. It gives me a chance to lower my cost basis, increase my dividend yield, and increase my potential future returns. Now, on the flip side, if something has happened and the company is, not making sales, they're going bankrupt, someone's looking to buy them out, they're having issues, financial issues, whatever they are, they're in too much debt. If something has changed with the company, that's a different story. Maybe it's time to get out of the company and go look for a different position. So that's why I do this. Hopefully that makes sense. But here in this column is the tickers, all the companies within the portfolio, plus the two ETFs, the total shares of each company, current price as of the close of business on Friday, market value as of the close of business on Friday, my average cost per share, my purchase price, how much I have into each position, my total return, whether I'm up or down. Again, I'm going to show it transparently every week. The percent up or down, right? Obviously, if I'm in the green, that means I'm up. If it's red, that means I'm down. What sector they fall in, whether they're a quarterly, monthly, semi-annual payer. Current dividend yield as of the close of business on Friday. My yield on cost, the portfolio weighting. What we saw on the previous slide was the sector weightings. This just shows us each individual position weighting. Estimated annual income in this column. Payout months here. Dividend growth year over year, and we've talked about some of the ones that don't have any dividend growth. I am watching over the next year, year and a half. I probably will be eliminating some of these positions if they don't start growing their dividend again. Where the company sits at 15% of its 52-week low. I use this as a high watermark. Let's talk through a position or two here. Excuse me. Sorry, my sinuses are killing me today. I haven't taken my Zyrtec this morning. Bank of America, for example. I'd like to build this position out. My cost basis is $34.42. Really, I'd like my cost basis to be back here at $28.70. I am a little over my cost basis, so I'm not going to be adding this to this position, right? This 15% of a 52-week low gives me a high water mark of where I'd like my cost basis to be. Now, total shares, I currently have 6,745.136 shares. Portfolio is worth $254,819.39. I have $249,225.61 into the portfolio. I am still up $5,593.78. This has been pulling back. The overall portfolio has been pulling back several weeks now. Percent return still up about 2.24%. I do not focus on these two numbers. If you've been watching this channel for any length of time, you know that this isn't where my focus is. Yes, I want to see growth in the portfolio. Don't get me wrong. Current dividend yield 4.428%. My yield on cost 4.527%. This is what I focus on. That is why it's circled in red over here. The dividends paid out by the portfolio, the annual income paid out by the portfolio, all the positions in the portfolio, and the dividends they pay out, whether they're quarterly, whether they're monthly, whether they're semi-annual, whether they're twice a year. This is what I focus on. Currently sits at $11,283.45 in passive income expected over the next calendar year, getting very close. I think by the end of July, we will be at right around $12,000 per year or $1,000 per month in dividends, right? Really like to see this increase every week, and that's what it does. By the new capital that I put into the portfolio, by the positions in the portfolio paying out dividends and buying more shares of those companies, and as well as by these companies increasing their dividends over time. That's why I have these ones highlighted in yellow. These ones have increased their dividends already this year. Those are the ways that the capital in the portfolio, the dividends, the estimated annual income, that's how they grow, right? By the capital I put into the portfolio, plus the positions pay out dividends, plus those companies raise their dividends. That's why we're so focused on dividend growth. We want to see dividend growth. We want to see companies raise their dividends because that helps us out with that dividend snowball as well. Now, currently, dividend growth sits at 5.81% estimated year over year. So that is the estimated dividend growth. Whether I add new capital or not, it should grow by about 5.81%. Now, this will adjust. This number will adjust as these companies adjust how fast they grow their dividends. Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of dividend growth investors so we can share our experiences, share what we're buying, what we're selling, what we're watching, what we may be avoiding, tips and tricks that we've learned along the way. We can't benefit from each other's investing, but we can certainly benefit from each other's investing knowledge, right? And that's what it's about. It's about sharing the knowledge. You're going to see whenever I make a mistake, hopefully you can learn from it and not make the same mistake. You can ask me questions. I'll answer them down in the comment section. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topic. And that is what this channel is about. Not only for new dividend growth investors, but those who have not started. Again, hopefully seeing this portfolio built out week over week gives you some confidence that you can do it too. Again, I don't have a degree in this. I go to work every day. I have a wife, 2 kids. I do read a lot of books on investing, and I try to read, from the best investors out there, the Warren Buffetts of the world. And you can do it too, right? And whether that's picking individual stocks or whether that's ETF investing, that's up to you. But on this channel, dividend growth investing is what we focus on. And hopefully you are benefiting from the content. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for tuning in on this Father's Day. Again, happy Father's Day to all the fathers out there. Really do appreciate you all. And take some time to spend some time with your kids, wife, your family overall today. Don't forget to call your dad. We'll see you in the next one. I'm not a financial advisor. You can read the rest of this. I'm going to go in and have breakfast. My wife will cook me breakfast this morning, so that's what I'm going to go do. Hopefully you have a great Father's Day. We'll see you in the next one.